Now, before we get into Asia, we'd like to remind you, please like, share, subscribe. There's a lot of good content that we like to go through. Hopefully it's helpful in terms of understanding what's important and what's happening in today's, COVID-ridden, upside-down world. So the one thing that we wanted to compare first was where China goes, so will the G10. And I thought this was an interesting chart looking at where China typically ends up. And this is, again, looking at economic surprise index versus the G10 economies. And when you look at what typically happens in China, China is a huge piece of many supply chains throughout the world, not just the U.S. So typically when you see China come down, and you can see it's typically a leading indicator in terms of where things go, just the propensity of how just negative things have gotten, given there's a lot of things that have kept things fairly elevated, especially some sort of stimulus, whether it be fiscal or monetary, has been supportive of some of the G10 economies, but it's just becoming more and more costly to try to fight kind of this underlying slowdown that we're seeing on a global level. Not just, some of these economies in their own kind of bubble can be fairly strong depending on what is the driver. But when we look at just the industrial side, the manufacturing side, the shipping side, that's where we continue to see a lot of these problems, which is when we start looking at the fiscal stance, U.S. versus China. So the U.S. budget deficit versus the Chinese budget deficit, we're continuing to see a lot of this. Obviously, the U.S. needs a lot of borrowing, but so does China. And this is what they've been trying to cut, especially that special government bonds or the SPBs. And that's where they continue to try to rein in some of this borrowing, take some of this excess out, which is also limiting the amount that they're willing to stimulate on a monetary side, where the U.S. is hitting it from both fiscal and monetary. But this one is obviously driven by the fiscal. So this is where we continue to see shortfalls. That's going to require more borrowing, which is going to put more treasuries into the market. But as we said, even in the European segment, the U.S. is not the only one, and neither is China, with the need to increase debt. It is happening around the world, which again is leading to this continuous issuance, which is what happens when central banks are not the main buyers and start to go into a less accommodative role. How are these fiscal deficits going to be funded? So when you look at yield spreads, you can see the China 10-year yield has remained fairly sticky. Even obviously the U.S. and yield started to go up. Now it's sideways a bit, taking kind of a breather to the sideways side. But China's gotten worse, and it hasn't gotten much better since. And the reason why is that underlying fear after Huawei sanctions. You look at Iran and what has happened there with their defaults, near defaults. We've seen a big increase in general defaults across the board, which again is leading to some of those underlying concerns for, well, how safe is that bond? What is the security behind it, and are there going to be more defaults? And we're going to go through, because the S&P did a great research report on it. The answer is yes. And the question is going to be what industry, where is that happening, and then what could be the knock-on effect from that? And when we look at U.S. and China unicorn births, now I learned something new yesterday, is what is a unicorn? Because as someone who has 3 girls, I know of a unicorn to be something very specific. And it wasn't that. So this is looking at unicorns or companies that are VC backed, that are worth $1 billion, and there's a lot of reasons why a lot of this is false, or at least not really. But again, neither here nor there, they're worth $1 billion. And you can see just the amount in the U.S. versus China. China has brought a lot of these to light, but now you can see they've been falling off as they've tried to tighten monetary policy, and as the U.S. has maintained a very loose monetary policy. You can see just how elevated and what those growth models look like versus China. Not exactly the most sustainable backdrop, given the fact that a lot of these still have not, or the ones that launched in 2015 and earlier are still not even at an actual $1 billion in real valuation. If we were to model it out using actual revenue, the thing where you actually make money doing what you say you're going to do. So then when we look at credit impulses and credit defaults, this is, again, pulling in the defaults in the first half so far, which you can see completely take out what we've seen in 2018, 19, 20, and credit impulses. So again, the credit impulses are continuing to come down because this remains a big focal point for the PBOC and the CCP. So when we look at what is happening in general, so restoring the commodity attributed we're now starting to see some other shifts, and the other shifts are electricity, because electricity, typically household electricity in China is protected, or it's at a fairly steep discount. That is now starting to go away. So making a household electricity prices better reflect the cost of supplying power. What have we seen? We've seen hydro dams fall down in terms of what they're able to produce. We've seen coal prices explode, which has then pulled LNG prices higher. So the cost of electricity has inherently gone up, and the government is essentially saying, look, we don't have the ability to subsidize the way we did. So some of this is going to have to adjust, and electricity is going to be one of those big ones because of a strange pricing system. Electricity in China is cheaper for households. In 2019, China's household electricity price averaged 40% of average levels in OECD countries. So you're just getting an idea of how cheap it was, which is why they're starting to crack down on crypto mining and a lot of these other projects in order to try to pull some of the electricity back out of this sucking sound, because based on just how cheap electricity was, Chinese households wasted a lot of electricity. They didn't feel the need that they had to be worried about it. Meanwhile, industrial users end up having to pay more than they should for electricity. So trying to stimulate the economy, stimulate manufacturing, cut some of the savings to the consumer. Again, some of the adjustments that we're seeing, but it's also going to be a little difficult because they also want the consumer to spend more. So if you want the dual circulation strategy, driving home local consumption, but you're going to raise electricity prices, it's going to be fairly difficult to see one lead to the other. And again, some of these underlying problems. But it's not just China, and this is what we talked about in the EIA show, but in India as well. So fuel prices in India are at records, even though Brent is well below its peak. So when you look at Brent, based on where it is now, where it was in 2014, and where pricing is, they've decreased the amount of subsidies and they've increased the amount of taxes. Why? Because India's deficit continues to grow. And the deficit is including tax receipts coming from gasoline and diesel. So even though in theory they should cut these taxes on the federal tax and the state tax, it's very unlikely they'll be able to do so, because if they do, the fiscal deficit's going to get worse, and we're already seeing inflationary pressures go higher, which is already forcing them to pull back on some of the borrowing that was already planned. And China is no different, because if you look at China, there are a lot of inflationary pressures that continue to get worse. PPI has gotten worse. It was at 9. It's actually even worse now. So as this data continues to come out, you can see how hot a lot of this is running and how it's actually accelerating, which again is going to put more pressure on households and the export price, because export prices continue to move up, which are having a bigger issue in terms of where things are going, how things are progressing over time. But what is that doing? That's forcing companies, that's forcing consumers to slow their overall backdrop. Because what are they doing? Well, let's look at PMI. So non-manufacturing PMI survey was for 55.3, came in at 53.5. Manufacturing PMI was expected at 50.8, came in at 50.9, composite at 52.9. So they're still expansionary, but they're slowing, and they're slowing month versus expectations, but also slowing against where they were prior, because we continue to see this pressure within China. And this is looking at June, because May was already a struggle. June is struggling more, and we're not seeing anything on the other side to really prop that up, because debt is the overhang. The consumer doesn't feel comfortable. We're seeing this overarching problem and fear within the country, which is leading them to not enable them to get back to normal. And when you look at just those changes in PPI, so industrial goods and export prices. So when you look at just Chinese PPI industrial goods, which is a 3-month leading indicator, this is why we keep talking about export prices going up. Now, that's the US that's going to get hit. That's Europe that's going to get hit. Then if you look at freight rates, which are going up, you look at diesel prices that are going up, all of this is driving higher, and we're just not seeing that backdrop. We're not seeing it get any better, again, supporting that elevated pricing. So now, what are some of the other issues that they've talked about within China? So let's look at what Huawei said in terms of at their May symposium. So Ren, who is the founder of Huawei, on employee question about the wisdom of manufacturing localization, which is achieving self-sufficiency in core components such as semiconductors. Ren said that China still has a lot to learn from the U.S. in terms of science technology. We cannot think that just because the U.S. oppresses China, that it is not a teacher and that we have nothing to learn. He also had some words for Shen Ping, a professor famous for his anti-Americanism and views on Huawei's strengths vis-a-vis its U.S. counterparts. Shen Ping talks about social issues. I talk about science, education, and technology issues. Social issues are for politicians to explain. Science is the truth, and there's only one answer. In this regard, the U.S. is strong. So the debate remains over decoupling between China and the West, and how do you decouple without having that technology, that know-how, which is where these friction points come in. And if anyone understands the risks of tech dependency, it is the founder of Huawei. The fact that Ren has come out against decoupling is significant. So this is where now you're starting to see the business side saying, look, I get that there's issues on the political side, but we're not there yet. And these are things that the CCP and Xi does not want to hear. So we've already saw what happened when May came out against Xi or had commentary about it, like the Apple newspaper in Hong Kong printed its last issue. This crackdown is becoming harder and harder, and again, it's leading to friction not just outside the country, but within the country. And you saw Xi had a big purge since 2012, make sure that he solidified power. But there's always a concern about, well, where is their discontent? Where is their potential for friction? And is that going to force them to move faster than they really want to in Taiwan and some of these other regions? Because Xi is going to need to show that there's a certain amount of strength. He's been playing up during the 100-year anniversary the struggles of Mao, the creation of the Communist Party, how Xi has brought it to the next level, because again, they need this propaganda, they need this capacity to make sure people stay aligned with the party. So now when we look at China business conditions within China, you can see that things have flatlined. Market growth has remained strong. But look at sales growth. Sales growth is flatlining down and moving lower. Like we had a little bit of a bump and now it's coming back down. Prices charged index is at an all-time high. Staffing index at a low. Profit margin flattish right now. But the question is going to be how much of that is going to be passed on. So again, we're not seeing a massive recovery out of China, even though they're that have come out of the COVID overhang first. We're just not seeing that same type of excitement, and the retail side continues to fall off. So when we look at retail slowdown, this is looking at sales revenue, profit margin, workforce, sales price, borrowing. All of it in Q2 is weaker than in Q1. And when we look at what's going on going forward, we don't see that changing all too much. We're not seeing this huge surge of activity because the retailers continuing to struggle as credit is tight, and it's going to remain tight because they're trying to pull back on those credit impulses, and the consumer remains weak. They're not going to Macau. They're not going to buy anything because, as we showed with the world economic data, that staffing is fairly flat. It's not growing. It's not declining. There's just not much happening to really drive that excitement. So when we look at China's domestic debt, here's the general government household. So again, just looking at just the amount of debt. This is before we go in and then dig into the different nuances. So why is this a problem? So now we talked about Ren and Huawei. Now we're looking at the amount of debt on the government level, household level, and non-financial corporation level. So look at the amount of debt at the corporate level. A lot of that is now called into question. So now we have Ren who's saying, look, we need the U.S. You may not like them politically, but we need them scientifically. But the wolf warrior diplomats are the ones that are going out there and essentially driving people into the arms of the U.S. and the West in general, or at least away from China. So according to the Wall Street Journal, the foreign minister of China had something to say. So the foreign minister is taking steps to pull back on the aggression, including by drafting guidelines for diplomats on the use of Twitter. The wolf warriors are a controversial bunch within China's foreign policy establishment. Many highly placed officials have been trying to rein them in over the past year. It's not clear that Xi wants to put a leash on the wolf warriors. In a May meeting with senior party officials, he urged efforts to cultivate a credible, lovable, and respectable image of for China abroad. At the same time, the people say he has maintained demands that diplomats show fighting spirit as they defend the country against insults. So this is that friction that we continue to see, not just with the U.S., but also with the broader community. But they need the broader community based on the amount of debt that is coming due, that needs to roll, and the amount of pressure that continues to come in terms of tightening their belts while trying to roll and maintain a certain amount of semblance and liquidity. So in 2021, each defaulter had 8.7 billion renminbi of onshore bonds outstanding on average. That's 1.6 times the size of last year, 3 times that of 2017, and 9 times that of 2015, year of the first SOE bond default. Defaults are increasingly higher profile with bigger impacts on markets and investors. So just looking at, even though the number of defaults have fallen, they have grown in size, and now we're finding out there's a lot of off-balance sheet risk. There's a lot of risk in general that is causing some fears of contagion. And what does that look like? Which is keeping spreads wide, which is increasing the cost of borrowing, the interest expense, and again, just weighing on how China can refinance and maintain a certain amount of semblance of normalcy. Default amounts remain fairly high while the number of defaulters trending down. So when you look at just what we've seen so far in the first half, moving up, but just the number has fallen, but the amount continues to grow, leading to just how much risk is there. And unfortunately, a lot of these individuals who are defaulting are state-owned enterprises, which are supposed to be safe. They're supposed to be backed by the government. And we're seeing a lot of that risk continue, which started with Yuan. So then when you look at the SOE default amount accelerated as the private enterprises slowed. So the SOE side is where we continue to see the amount of fear, that's where we're seeing a lot of these increases. And the focus has been trying to protect some of the micro, small, medium cap, which when you talk about electricity, you talk about forgiveness on some taxes and increasing levels in terms of when you have to pay taxes or different levels of taxes, levies, import levies, export levies. All of these things are being done where the SOEs, if you look at the defaulter numbers rise as POEs fall. So the SOEs are coming into focus more and more. And that's where that fear of contagion continues. Now, the onshore bond net issuance of local governments and property sectors. So net financing turned negative for both, raising risks of surprises. This is rare, especially for LGFVs, local government bond vehicles, which make up nearly half of the corporate market. Government tightening and leverage containment policies is the driver for real estate companies. So this is where we continue to see a lot of these risk factors, especially on the local and provincial level, not just on the national level, which is why there's some of this unknown as to what are the risk profiles, and this is where you're starting to see spreads widen, and it's becoming harder and harder to not only just roll debt, but you're rolling debt at a higher price. because yield is just going up. So then when you look at the most bonds due, real estate and LGFV are at the highest level when you go back, going through the remainder of the year. So when we look at just where we see some of this risk, it remains at the local government level, like the local government financing vehicle and the real estate side, both of which have very big ties to the CCP, to the backdrop of a certain amount of security, which again calls into question what they're willing to do to backstop. So a large majority are spec grade and unrated, which again leads to even more questions of, well, what's off balance sheet? What are the risks? How, if it goes bankrupt, what are my means of getting compensation? A lot of these unknowns continue to reverberate through the system in general. So when you look at offshore defaults remain elevated, you can see the maturities will peak in 2022. So it's not done yet. Things are still going to get worse. There's still uncertainty out there, and the need to roll is going, as they mature, they're going to have to roll that debt. So as more paper comes to market, there's going to be a more concern in terms of sustainability. And again, that is going to push more pressure into the system. And then the defaults, and just based on what we saw in 2020 and what we've seen so far in 2021, it's very likely that we're going to see an increase in defaults going through. And we're just not seeing so that's the corporate side, the government side, but we're not seeing travelers do much. We're not seeing the consumer do much. Now, given this is not like others than just, the mainland Chinese can go to Macau, but this is just looking at where people, even though everything is back open, because COVID-free Macau struggles to attract mainland visitors. We're not seeing that come back to normal. And just looking at it a little bit differently. So China implements border restrictions. Travel to Macau resumed in Guangdong. Travel to Macau resumes for all mainland provinces. Since that's happened, things have just flatlined. And that's where we continue to point to that as what is happening for the Chinese, what does the consumer look like, and we're just not seeing that come back to normal, which not only is just a problem for let's be fair, based on their debt issues and industrial slowdown, manufacturing slowdown, export prices going up, they're not getting much help from the C in that consumer in the calculation for GDP in terms of propping up and providing some of that uplift. So then when you look at growth and inflation forecasts, the CPI remains depressed. And I continue to believe that the PPI is actually going to continue to go up, not at the same rate of change. You're going to see it start to crest, but I think this is a bit exaggerated in terms of that drop down. Now, they've tried to go after commodity prices, but we've still seen commodity prices go up. We've still seen a lot of stress within China. In terms of their supply chain and raw materials, which is going to keep that PPI elevated, and they're going to have to start passing that down to the CPI. They can only increase exports so much. We've already seen countries start to turn away from China and trying to find, South Korea, Japan, trying to deviate or at least spread out where they're getting some of their raw materials from and starting that trade. It's going to become a much bigger issue, and that's going to impact growth. That's going to impact inflation, and they're going to have to realize more of that on the CPI level, which we already talked about on the electricity side, which is just, again, another step. And when you look at the PPI breakdown in terms of where things look, you can just, raw materials remain elevated, but the manufacturing side, it's not just raw materials. Raw materials is just a piece of a very big puzzle. Now, obviously, it's a huge part of it, but there's excavation, there's manufacturing, there's refinement of it, there's demand. Like all of these things are why it's going to be difficult to see it it's difficult to see it come down. Where maybe it stops going up, which I actually think it goes up again, but then one or two more clicks up, and then you'll start to see this kind of flat line. But again, not come down quickly. This is going to be a prolonged problem, almost similar to what we saw in 2010 to 2011, where we just saw it fairly sticky. Like there's a lot of problems on it. Some of them are not even just COVID or China issues, but their relations with other countries: Australia, South Korea, Taiwan, South Africa, Brazil, Argentina. And then what is the availability? Do you even have the copper or the coal or the steel available. These are those problems that remain in the system. And again, speaking back to the price of coking coal delivered into China has continued to rise, back now above where we were in 2016. So these are the pressure points that we continue to see, and it's unlikely to see that pare back over the next few months. So then when we look at Japan, this is where we're starting to see some slowdowns. So supermarket sales have come back to normal. CPI surprised to the upside across the board, just flat. But jobless rate surprised above the survey and was up versus last month. Then you look at retail sales, again, fairly flattish. Department store, supermarket sales, coming down a bit. Industrial production slowing, and industrial production is the bigger issue, because when you look at month over month, expected was at 2.1%. It came in at negative 5.9%. When we look at the export-import side, imports have slowed. Exports have remained fairly firm, but as imports slow, that's indicative of some of those issues that we're starting to see when we look to, okay, well, where is industrial production? We'll get an uplift in June, but it's going to still remain fairly muted as we go through, because Japan is still struggling, excuse me, to see some of that normalcy on the economic level. South Korea, something a little bit similar, where things are holding steady. Business surveys, discount store sales, moving up, you're moving on a steady level, but then industrial production missed estimates. So again, you saw estimate for industrial production was 18.3%, came in at 15.6. Month over month was expected at 0.7, came in at negative 0.7. You're starting to see some of that knock-on effect from China and those slowdowns that are ramping up, which is just pointing to some of that, again, what we're seeing outside of just Asia, but into the G10. How does that filter down? Because this is where we buy a lot of our stuff in terms of semi-finished goods, completed goods, which is leading to some of those issues that are continuing in that on those levels. And then when you look at India, speaking of some of these different backdrops, India oil's all sector sales manager index charts are now they're declining. You can see the sales manager index is getting worse. You're seeing things were starting to get back to normal. Then we had wave 2 of the COVID, and now you're starting to see some of those hindrances. But it's across the board. We're seeing issues in business conditions, in market growth, sales growth, prices charged are actually still elevated, but staffing levels have gotten worse. And that's when we start looking at staffing levels in terms of how quickly can India get back to normal? Can consumers spend? And we're seeing that really start to pare back. And again, the staffing levels are indicative of some of those problems. Then when you look at the summary of the ASEAN currency drivers, and this is where, as the dollar has strengthened and stays at this level, it's starting to become an overhang, which is why when you look at U.S. growth, it's a net negative, which is why when we talk about emerging markets, a strong dollar is going to be a problem for where some of these currencies are and what their buying power is. And it's something that we talk about in an opinion piece that we put together for Politics Today, which looks at 3 of them. But again, that can be carried into a lot of these other areas, especially when we look at Indonesia, Myanmar. Myanmar, we did a deep dive on it previously in the first segment, which is just looking at the geopolitical issues and how that's going to become a much broader problem. So when we look at China, emerging markets, ex-China, Korea, and Taiwan, there's not the same type of overheating. When you look at how things on the private credit growth is weak, but then when you look at emerging markets, ex-China, Korea, and Taiwan, the overall credit side still remains low in terms of where things sit. But core CPI, now this is where this remains low, but it's going higher. And as this goes up, private credit growth is already going to be at a hindrance, because do I want to buy Korea? Do I want to buy Thailand, or is it safer to buy U.S.? And that's where, as there's a huge influx of developed paper, Why am I going to take the risk in some of these emerging markets, especially when you start looking at carry trades and what the underlying problem is? So again, it's going to be a problem when you look at the taper tantrum of 2013, which is what this is trying to compare to, versus right now. And I still think that there is a lot of problems that we've highlighted over the last several months at the emerging market level. And then just round out, one of the largest emerging markets, India, consumer confidence falls to an all-time low. Not surprising given the second wave, but it's a huge knock because staffing has come down. You're starting to see bankruptcies increase. You're starting to see strain at the financial level in terms of budget deficits, not just on a state level, but on a national level, federal level, but also on a state level. A lot of these problems are continuing to roll out and are some of the bigger overhangs that we think are going to continue to become a much bigger issue over time, because current situation never got back to pre-COVID, and it still has now gotten worse, where future expectations are going to struggle to come back this time because we're not seeing the same type of resilience. And then there's a lot of these prolonged issues looking at underlying trade. So I know we covered a lot. If you have any questions, please let us know. We're going to cover in more detail India, China on Friday, because there's a lot to talk about when we look at Ladakh and what's happened with some of the attacks on some of the Indian airfields. So if you have any questions, please let us know. You can find me on Twitter, LinkedIn, or leave comments directly. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.